goes below 86, you don't have to pay anything. Well, the hedge in this case, if you sold these calls, is you have to buy something. You have to buy the underlying. How much do you have to buy? Well, it turns out that since it's right at the strike, if you assume sort of a random market, over the next day, half the time it's going to be above the strike and half the time it's going to be below the strike. So the hedge ratio, the probability of the option being in the money, is a half. The hedge ratio is a half. So the answer is, if you sold 100 calls, you need to buy 50 futures. So if the market goes up to 87, you lose a point on 100 contracts. You remember you sold 100 calls, but you make a point on your hedge, so you're net out minus 50. Okay? So if the market goes up a point, you're down 50. If the market goes down a point, well then how much are you out on your calls? 0. But you're long 50 contracts, you've lost a point on that, you're net out 50. So in both cases, you have the same identical outcome. You're perfectly hedged. Now you might say to yourself, why would you ever do this trade where in every state of the world you've lost money? The answer is you took in premium for selling the option. Hopefully you took in more than 50, you'd make money. If you sold the option for exactly 50, you'd break even if this happened. Okay, so that's the hedge if there's one day to go and you're right at the money. Let's suppose there was 2 days to go, and you did that hedge, and the market went from 86 up to 87. So now the option is much more in the money. It has 1 day to go. Probably the odds of it going out of the money, back down below 86, might be pretty low for just 1 day. So what do you have to do to change your hedge ratio? Remember, you're long 50 contracts. So let's say there's 1 day to go and the option is way in the money. What do you have to do? You have to buy more contracts. Because now, for every movement on that final day, for every movement up, you're dollar for dollar out. And for every movement down, it's still going to be in the money. It's almost as if you were short the future, so you have to buy 100%. What if the market went way down? What do you have to do? Well, now how do you have to adjust your hedge ratio? Now the odds of the stock market or the market rallying enough so that it's in the money are very low, so you don't need any hedge. So when the market goes down, you need to sell out your 50 contracts. So let's think about this strategy once again. You put on a hedge. As the market goes up, you're a buyer. That's your dynamic hedge. As the market goes down, you're a seller. So as the market goes up at the high, you're a buyer. You're a buyer at the high. As the market goes down, you're a seller at the low. Crazy strategy, right? Who would ever do this strategy? Buy at the high, sell at the low. The answer is you were paid a premium to do it. So every single one of your hedging trades is a losing trade. But against it, you've taken in this premium. So this strategy is referred to as dynamic hedging. If you're long or short an option, you can generate it by dynamically trading in the underlying. You put on the hedge ratio to start, and then as the market moves, your hedge ratio adjusts. As the market goes up, you're a buyer if you're short an option. As the market goes down, you're a seller. Well, this option is struck at 86, and I sold it when the future was at 80. So what do I have to do to hedge? I have to buy some futures. How much futures do I need to buy? Well, obviously it's less than 50%. It's much less because the probability of it being in the money is low. But I have to buy some futures. Why have I done this trade? I've done the trade because the implied volatility in the options that I've sold was much higher than I thought would be realized. So I think that my hedging if that's the case, my hedging transactions are going to lose less money than the option premium I've taken in. If I sold these options at a 15% volatility, and actual volatility is 10%, then my expected profit is 5 vol points. So another way of calculating the expected profit is you can look at the options that I sold at, let's say, a 15% vol, and that's a certain premium. And you can then reprice those options at a 10% vol, and the difference is how much I'll make in expectation. But the path matters. This path over the next month was remarkable. This is the futures contract. It remarkably started just trading up. So what does my profit look like here? Well, maybe I bought 20% of the underlying as my initial hedge, and every day I'm buying a little bit more. But because the market's not gyrating, because it's generally moving up, all of my hedging transactions are making money. Even though in expectation I was only going to make these 5 vol points, I'm actually making a lot more because my hedging transactions are just fortuitously making money because the market's not gyrating, it's just generally moving up. So, whereas my expected profit, if you just value the options, well, here I've got a 22% versus 15, would have been $700,000. That's what I told my boss I hoped to make on the trade. My actual profit on the last day was $3 million because I had made so much money on the hedge. Ooh. Can we get that back? Okay, so now it's the last day of trading, and the future is at 85.5. And so let me tell you how so it's a Friday. These options expire on a Friday. I think it's the spring. It's probably something like, let's see, it must have been March and June, must have been June. The options stop trading at 1 o'clock in the afternoon. There's a final round of trading, then they stop trading. The futures market in treasuries is open until 3 o'clock. Then that stops trading. Treasuries generally trade till around 4:30. There's no set time, but generally around 4:30 the market stops trading for treasuries. But you have until 5:30 to tell the futures exchange whether you want to sell these or not. Well, at 1 o'clock, these options that are at 85, the underlying Treasury futures at 85.5, and I've sold these 86 calls. These options are trading at around 8 cents. So, like a good model building guy, I said, do I want to unwind this trade with, do I want to pay 8 cents and lock in my $3 million profit? So I plugged the 85.5, and I assumed a half a day to go into my Black-Scholes option program. And I didn't get 8 cents, I got 2 cents. I'd much rather be a seller than a buyer. But I'm not going to do a trade for, 6 cents, the transactions cost, whatever. But I'm not going to buy these back, the calls that I've shorted, because I'm not going to pay 8 cents for something that's really worth 2 cents. So I didn't do it, and lo and behold, the futures closed at around 85.5 at 3 o'clock. Nothing is really happening. At 4 o'clock, all the partners, my boss, they've gone off for a partners weekend. They're off on a golf course. I tell them not to worry, I'm in full control. It's a little before 4:30, got my feet up on the desk. I'm talking to the long bond trader about what he's doing for the weekend. No problem. So then Friday at 4:30, Federal Reserve cuts the surprise cut of the interest rate. And these futures aren't trading, but boy, are bonds screaming. I do a couple calculations, assuming the same spread of futures to treasuries. And these futures, if they were trading, would be more like 88 or 89, even though they're stuck at 85.5 because they're not trading. So meanwhile, I do a little calculation. I hope to make $700,000 on the trade. At 1 o'clock, I was up $3 million. At 4:30, I'm really down more like $2.5 million. And I haven't even covered my position yet because the futures aren't trading. So what's the lesson from this? Well, I think that the lesson is, and I think it's somewhat the lesson of long-term capital too, is that models are good to help you get your intuition on a trade. So I used a model. I used the Black-Scholes with a half a day to go to get some intuition, and I thought this was ridiculous. But you have to know where the models work and where the models break down. The Black-Scholes model on a short-dated option with that's out of the money is notoriously bad. Why? Because the assumptions of continuous markets is probably not a good one. Later on, when the smoke cleared, I redid my calculations using, on the 8 cents, using a combined model that assumed continuous movement and jumps, and I saw that 8 cents made a lot of, worked. 8 cents probably was a fair price. If I had known that, maybe I would have locked in my $3 million. So I think the lesson is you have to understand the models you're using, where they work and in what regions there's problems.